In this video, we're going to discuss how your age impacts a mortgage application.
As the average life expectancy in the UK is increasing, lenders are adopting a more fair approach by bringing out products which allow you to borrow later on into life.
Age can also have an impact on your mortgage application, as the fewer years that the lender can lend to you, the less that they will be able to allow you to borrow. It also can present you as a higher risk. The main thing that a lender is looking at when they are looking at your mortgage application is the mortgage sustainable throughout the duration of the mortgage? And if that takes you past retirement age, then the lender needs to be comfortable that your income into retirement is also going to support the mortgage. Now, normally when you do retire, your income can generally reduce down, and that reduction then needs to be factored into the mortgage application. And can you afford the mortgage payments past retirement? Also, older borrowers can be less healthy, and therefore when it comes to a longer term mortgage, so let's say for example 25, 30 or 35 year term on a mortgage, is the likelihood here is will they survive during that term of the mortgage? However, as life expectancy has increased, as we've mentioned earlier, lenders have adopted a more flexible approach when it comes to retirement age. So whereas before lenders would normally allow your mortgage to go up to the age of 70, there are many more lenders that will allow you now to go past the age of 70. So some lenders will allow you to go up to the age of 75. There are some lenders that will go up to 80 and even 85. There are now also lenders on the market that don't actually have a maximum age for mortgages, and that means that more mortgages are available for more of the population.
Now let's assess borrowing past the age of 70 years old. If you're an employed individual, lenders have more of a fairer stance if you've got a non-manual based role, if you are looking to borrow past the age of 70 years old. So for example, you may be an office worker and you can do your job until the age of 75, maybe later on past 75 years old. That's absolutely fine. Some lenders will consider lending to you. Occupations that aren't more favourable for lending past the age of 70 years old are your more manual labour intensive roles. So this could be building site worker, could be a labourer, could be a bricklayer, for example, or even a lorry driver. So lenders will have a firm stance around what the maximum term they will lend based on them sorts of occupations.
Also, if you're a business owner, the lender is much more likely to allow you to go past the age of 70. And that is because you're in a non-manual role. So because you're just managing the business and that business is able to perform past your age of 70, they will allow a mortgage to go further into retirement.
If you're looking at borrowing into your 60s, lenders typically will look at what your income is going to be going into retirement. So typically speaking, what your pension is going to generate for you. That's because you're so close towards the state retirement age or expected retirement age. So although you've got employed income currently, normally it's handy to have all your pension statements available, and that's where lenders will assess your income.
When you're looking at a buy-to-let mortgage, your age becomes less significant. And the reason why that is because when the lender is looking to assess the affordability of the application, rather than looking at your own individual income, the lender looks at the rental income that the property generates. And because that income is going to be generated no matter what your age is, the lender will use that figure as opposed to your own personal income. So there are different types of mortgages available for people that are wanting to look at later life lending. These typically are retirement interest only mortgages, term interest only mortgages, and equity release mortgages. These types of mortgages are generally available for people past the age of 55.
Retirement interest only is using your retirement income without actually having a defined term at all. So effectively, you have the mortgage until you die. And the good news is you can actually potentially go up to 75% loan to value, depending on market conditions.
So a term interest only mortgage is very similar to a retirement interest only mortgage. The only real difference between the two is where the retirement interest only mortgage has an indefinite date, a term interest only mortgage has a specific date for the borrowing, and that can be anything from 1 year right the way up to 25 years. So with both retirement interest only mortgages and term interest only mortgages, you can potentially get up to 10 times your annual income. So even though that we are only using retirement income, so your pension, the lender will use a lot more proportion of that and will give up to 10 times that income.
And the final scheme available to the elder borrower is the equity release. Now, unlike retirement interest only and term interest only, equity release isn't affordability assessed, neither is it credit assessed. So effectively, the equity release provider will take a charge over the property. Now, depending on the age you take out the equity release mortgage depends on what the maximum you can actually release from that property. An equity release mortgage is a very, very specialist mortgage and requires a different qualification to a standard mortgage application. So make sure you're seeking advice from a fully qualified advisor.
So as you can see, as life expectancy increases, lenders are adopting a much more flexible approach when it comes to your age.
For more helpful mortgage tips, please check out our next video.